Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do our Twitter thing, almost like a daily occurrence. We're going to rip through it, see what people are talking about, see what news or information people are sharing that pertains to commodities, financial topics, and wealth building areas. So let's just dive right in and see what's going on. Again, you can follow me at finding_finance, or you can join the website that we've got, our community, finding-value.com. You can use the word discount in the coupon code. So time for commodities to get a turn from JC Parrott's, I guess he's all-star charts. And look where we're at. We're at a downtrend line. And this is the S&P versus the commodity index. Are we going to get a turn here where we head lower, where commodities start to outperform? I heard Jim Bianco talking about he thinks that the inflation numbers are going to kick up based off of the base effects. So what it is you calculate your inflation rate from the consumer price index today versus a year ago. Well, that's kind of flattened out. The base effects have come up, and we're just waiting for maybe a renewed trend to come up as your base is basically stable now. So it's much like how they calculate a lot of the real estate stuff too. So could we see a outperformance of the CRB index and potentially an underperformance for the S&P and NASDAQ and stuff like that? And I think it's going to be highly sensitive to interest rates. So that is what you want to watch. Watch the 2-year, 10-year interest rates and see how they are reacting to the markets. And that can give you a better insight to where this could potentially go. Scrolling down, 421,000 ounces of silver out of the COMEX vaults today. We've got another renewable energy shocker. Record renewables in 2022 didn't cut fossil fuel consumption. Oil, nat gas, coal still accounts for 82% of global energy consumption. I don't even know if renewables are necessarily cutting into any energy. They're basically not even cutting into the growth rate that we're going up. I mean, we're growing at a certain amount. Energy is expanding by that growth rate. I don't know if renewables are accounting for all of just the growth that is out there. If it's still stuck at 82%, that means that they're not even covering greater than 82% of the growth rate, because it would start to cut into that percentage the way it's calculated. It'd have to account for more than 82% of the growth rate to eventually cut into the base production numbers. Mike Simonson, he says, what if homebuyers are more sensitive to rapid changes in mortgage rates than the level itself? We're seeing signals of demand stabilizing at 7% mortgage. More new transactions this week, fewer additional price cuts. So we've got 460,000 single-family homes are on the market across the U.S. That is up 1.9% from last week. Last year, inventory was rising 6% per week. Still 10% fewer homes on the market now than over New Year's. So here's New Year's in the beginning there. You can see that we are lower and that we're at 460. So 460,000, guys, this is really, really low. This is by far a seller's market. Even back in 2019, we were up around 800, 900,000. So we are still lower than a lot of areas in history. It says last year, new listings were surging in June as supply was pulled forward for anyone who wanted to sell in 2022. There's no surge this year. 84,000 new single-family listings this week. 21,000 of those are what we call immediate sales already in contract. So these are new listings, and these are the new list immediate sales that are already out there. Since there are buyers at these prices and these mortgage rates, few sellers need to do price reductions. 31.6% of home sellers have taken a price cut. That's up just a tad from last week. Fewer price cuts now than in 2018 or 2019. This is much more balanced market. So these are the percent of people with price cuts, 31.6%. And obviously, it's not the same as 2022 or 2021 when the market was going ballistic, but we are lower than 2019 and 2018. Median price of single-family homes in the U.S. is $455,000, unchanged from last week. From this angle, home prices are fractionally lower than last year. The price of the new listings, light red line, is at $410,000. Watch for sharp declines like last year if demand stops. And that's the cycle too. You cycle back and forth, like you can see here. Trampoline jumps. The price of homes going into contract is now higher than last year, 383,490 median price SFR newly in contract. New year-over-year comparisons get easy. Home prices dropped in July and September of 2022 and rates spiked. Assuming no big rate jumps from here, bullish for sales prices. So sale prices are coming back. This is the median price of homes newly in contract. So that's also looking quite good. So rolling down, so these are the latest signs that home buyers have adjusted to 7% mortgage rates. Coming on back, we've got a chart that shows the prolific U.S. LNG growth from 2024 to 2032. Should all proposed projects be put through? This staggering figure, 28 billion cubic feet per day growth for a total of 42 billion cubic feet per day, does not include Canada nor Mexico's liquefied natural gas market. U.S. accounts for 50% of global LNG growth dominance through 2032. This is also why I am bullish in natural gas. I think the companies can grow their natural gas production into this gigantic capacity. It says the tables below show the status of the various LNG export terminal projects in the U.S. as of June 2023. We also note that there are also several LNG export projects that have been proposed in Mexico that would source their gas from U.S. production regions. So this is the timeline for U.S. liquefaction capacity, and it just ramps way up all the way to 2031. This is where we are today. You can see the ramp just recently, and then how it ramps up way more into the future. Coming down, it says the market bottoms when the Fed pauses. It says, oh, really? Whenever? Have analytics shared by BPR. So this is the Fed pause, the first Fed cut, start of recession, and the S&P low. And this is kind of what that shows us is they paused July 6, 2006. They cut in 07. You can see the start of the recession was shortly thereafter the cuts. Pause in 2000, 01, 01, 89, 90, 81, 82. So another thing to keep in mind here is these were all peaks in housing market. Peak in housing market. This one here isn't. It's a technology bust. Housing market, housing market. This is all housing market here. Housing market in 73, 74, the pullback. 69 was also, you could say it was a housing market pullback. The average decline from the date of the Fed pause to the ultimate low in the S&P 500 is minus 25%. The median is minus 20%. Do not buy the first rate cut either, as the numbers are similar as with the pause. Tell me, does anyone ever tell you to sell the market on the first Fed rate hike of the cycle? S&P 500 bottoms when we are 70% of the way through the Fed easing cycle, 2024 story. In other words, 16 months after the pause. So if we get a Fed pause, add 16 months, and that's generally where the S&P 500 bottoms. Meta, so it doesn't get much tighter than this at the top of an ascending wedge. I thought this was really interesting. So this is Meta stock. You can see that we've been coming up and up and up and up. We are really, really tight here. Which way is it going to break? We'll find out. But he has this kind of cool chart, something to look at and watch. It says, we believe the magnitude of coming stock draws will overwhelm the now one-year-old recession narrative, ultimately leading to a price rally. At least that's his opinion. Oil inventories and oil price correlation, which is kind of weird. We have inventories continuing to decline, even though we have been declining in price. So relationship breaks down at the red mark here, and we've seen a new era in 2022 where prices disconnected from drawdowns of inventory. Now, is Eric right? Or are we going to get inventories that go back up? I don't know, but I am sold on the commodity bull market. I am sold on oil doing incredible things during this commodity bull market, and oil in relationship to gold is incredibly cheap. So I have no reason not to think that oil could go higher based off of all of the valuation metrics. The thing is, valuations don't move markets. The markets are going to do what the markets are going to do. Maybe inventories will move the markets. That's possible, but we have to see the inventory draws, and I think that's what people are waiting for. They're waiting to see with their own eyes the inventory drawdowns, which will drive prices. Keep in mind the strategic petroleum reserves that came out of inventory. Those were not inventory draws. Those were viewed as extra supply in the market. Just an FYI for everybody. He says, even with a long-awaited recession in OECD countries resulting in demand falling by 0.4 million barrels per day, no sign of that yet, and U.S. willful blindness leading to Iranian production up 0.4 million barrels a day, inventories should still end 2023 at multi-year lows. So that's what he's thinking. The forecast that we're going to have a big drawdown in inventories. And let's see what happens. Very interested in the oil markets. Global floating oil storage hits highest level ever since October 2020 oil price. We've got said 3+ years ago, we are in for a glorious commodities bull, big inflation, and probably an energy crisis. Said back then, I'm expecting oil 250, 300 before this bull is over. Also said, then you need to make use of this bull market or it will burn you hard. I do hope you took notice back then. And I did. Don't worry. Not from him, but I took notice that a commodity bull market's coming. Chris says, and I share these every once in a while. It says the best form of healthcare is an approach that keeps you out of the healthcare system. Completely agree with that. Sunlight, movement, clean food, weightlifting, portion control, preventative care. The goal should be healthy on your own, not dependent on the system. The system, in my opinion, they just want you to get on a bunch of drugs so you can spend a bunch of money. That is their goal. I understand maybe some people, as they get, into their later age of their life, may need some of the drugs, whatever they are. But if you're dependent on it from a very early age, I think a lot of that can be prevented doing this stuff. We've got Business Insider put out an article today suggesting that 2023 home price forecasts are revising downward. The opposite is true. Since February, most 2023 home price forecasts have been revised upwards. So far, the 23 housing market has beat expectations. Back to Grady, he says, silver miners have hugely underperformed both metals and gold miners lately. End of the rainbow, get out of the rat race stuff if played right, and wipe out possibility if play commodities bull wrong. Life-changing money will be made. And this is SilJ versus GDX. The silver miners versus gold miners, very, very cheap for SilJ. Like off the chart cheap. Might be an opportunity there. We've got Bannerman. Bannerman's looking really solid still. Currently back testing the golden trend line and horizontal white support. There we go. Let's see if we can get a launch here. I can remember I called this 10 Baggerman. So we've got the BRICS here. BRICS will be taking over the global scene from the West. Coming gold-backed currency, phasing out the petrodollar, oil for gold deals, starting global institutions. These charts mirror that with showing a global shift in coming markets. So we've got emerging markets doing a false breakdown here. We're ready to rocket on higher. I agree with that. EEM versus the S&P, false breakdown potentially, and maybe we can get a nice big move higher. This is buying at what could be a very deep low. I know people ask me, I bought SM Energy And SM Energy had a bottom just like this. It came up real fast and then slowly came back down just like this. And we could see a bottom somewhere very soon in emerging markets. It says that 16-year bullish falling wedge tells us the odds for a global shift in the general stock markets are high, a shift towards emerging markets. Totally agree with that. Oh, I forgot to go over these. CEW, Wisdom Tree Emerging Currency Strategy Fund, false breakout, ready to move higher and break the trend line. And then we also have China in a 16-year chart. And I've noticed some Chinese stocks that are also bottoming in the technology sector too. They look like they're bottoming. Kind of interesting that we're seeing the same things. I said the expansion phase is coming. What does this mean? It means a boom for commodities. Here is Meritage Homes ready to break out. And guys, we can still get a recession, and this still could maybe even come back. It's possible if the entire market does come back down. It's possible, but it's looking good at the moment. We've got Leonard Corp that's up there. It looks like it's breaking higher in this expansionary phase. And KB Homes, I have this on log. I charted it non-logarithmic, but that is also moving on higher. So that also looks good. Kevin says, over the medium term, I envision a fiscal stimulus-driven secular demand boom for commodities in G7 economies to rival China's commodity demand boom of the 2000s, to lead the world out of a likely upcoming recession and drive the next global economic expansion cycle. Fiscal stimulus-driven secular demand boom. So that's maybe what we're waiting for. Maybe we need to lower interest rates. I don't know. We did that in 2002, which blew up the housing market. I think maybe something might come like that. Maybe it's going to rhyme, not be exactly the same as it was before, but just rhyme. But yeah, that's very well possible. The biggest thing about making money is time. You don't have to be particularly smart. You just have to be patient, says Warren Buffett. Another one, he says, most people get interested when everyone else is. The time to be interested is when no one else is. You can't buy what is popular and do well, says Warren Buffett. And that's why I'm stuck using the ratios, because it tells you what's not popular. And then you go and find those undervalued assets and buy them up. And then you just have to be patient. That's it. These two combined together, you can be deadly. Peter says oil market will tighten in coming weeks as SPR ends and OPEC cuts hit. Remember, U.S. does not import Iranian barrels and low-hanging floating storage already tapped. Market doesn't need kinetic Russian disruption to over-tighten, but might get it anyway. Bad time to be short. So that's what we've got for today, guys. That's where I'm going to end it. Give me a thumb up for the content, subscribe to the channel and the website if you'd like. But that's what I've got. And we'll see what happens over these next months. If things tighten up in terms of inventory, if we get a recession, however this all plays out. To me, it's kind of a flick of a coin on what's going to happen over the next 6 months, 12 months or so. So I'm just going to ride through it. I'm going to buy what's cheap and stay patient. That's all I got for today. We'll catch you guys next time. This is Finding Value.